This is Horizon's Middle East and Africa. Our top stories this morning. A mixed picture in Asia as Taiwan and Japan stocks rise on AI optimism, while Chinese shares tumble on tariff fears. SoftBank's been soaring after President Trump announced his new AI investment partnership. OpenAI, Oracle and SoftBank are forming a $100 billion joint venture. And President Trump says he's considering a 10% tariff on all Chinese imports from next month in response to the flow of fentanyl to Mexico and Canada. Well, it's just gone 8 a.m. across the Emirates. I'm Lizzie Burden in Dubai, in for Jumana Basechi. Those are your headlines this morning. But if we look at the market picture, it's very clear who's back in the driver's seat, isn't it? It is Donald Trump, of course, that pro-AI policy boosting risk sentiment around the world, really. But you're seeing it already in the Asia session. Futures are pointing higher stateside as well as in Europe too. You've got the 10-year US Treasury yield at 4.5% in the Asia session and Brent holding steady at $79 a barrel. The dollar strength having knocked oil prices yesterday. But if we flip the board, of course, market volatility really is the theme of 2025 so far. So a good way to track it, particularly when it comes to the tariff picture, is this ticker, the UBS Trump Tariff Losers Index. These are the US stocks most exposed to Donald Trump's tariffs. And you can see actually the sense of relief after Donald Trump's inauguration about the initial approach to tariffs. So definitely one to keep an eye on over the coming weeks and months. But let's check in now on how Asia markets are faring. Avril Hong's on standby for us at our Singapore studio. Avril, what's happening where you are?
Yeah, Lizzie. I mean, if you're a China stock market investor, I think that sigh of relief has kind of turned into a groan because despite this pretty good run that we've seen, a surprisingly warm start to US-China relations under Trump, we're seeing that turn tail after Trump reminds us that these tariffs threat still very real, talking about how, they could still impose these extra 10% tariffs on all China products. And he kind of linked this to how fentanyl is entering the US via Mexico and Canada from China. So the CSI 300 is heading for its first negative session in 5. We are seeing fresh pressure on Asia currencies as well, including on the renminbi. But this is on a day where, as you said earlier, it's a mixed picture and the tech stocks are really lifting the Japanese Taiwan gauges today. This is also thanks to Trump. Lizzie.
Avril Hong in Singapore, we thank you. Well, let's dive more deeply into that AI policy. SoftBank, OpenAI and Oracle forming a $100 billion joint venture to fund an AI infrastructure program in the US. Donald Trump unveiling the initiative. He called it Stargate and aimed it at speeding up US development of the emerging technology.
Announcing the formation of Stargate. So put that name down in your books because I think you're going to hear a lot about it in the future. A new American company that will invest $500 billion at least in AI infrastructure in the United States and very, very quickly, moving very rapidly, creating over 100,000 American jobs almost immediately.
OK, so it sounds very ambitious. Let's get into the detail now. Bloomberg Intelligence senior analyst Robert Lee joins us for more. Robert, is this really Biden's policy with Trump's name at the top?
Yes. Well, the high-profile CEO of SoftBank obviously has talked about these, very high-profile investments or potential investments really over the last 6 months or so. So I guess to some extent this has been well-trailed. But clearly there is a shortage of computing power on the AI side at the moment. So this announcement is, a big thumbs up and endorsement for the US AI sector. And obviously from the new president's point of view, with his pro-growth policies, again, this is just what the doctor ordered.
Well, the market definitely taking that signal this morning. I wonder, how is SoftBank actually going to finance the investment?
OK, like many companies, SoftBank is in a net debt position. There's no concerns on that front. But I think there is scope for them to maybe come to the markets on the debt side and raise new finance. But according to our credit analysts within Bloomberg Intelligence, they perhaps lack the headroom to do that. That also raises perhaps a more interesting question, whether we could see some divestments within their investment portfolio. The most obvious one being their stake in Arm Holdings, the US-listed UK semiconductor design company. So again, there's nothing behind that, but I think given the performance in Arm shares at the moment, or in year to date, to potentially take some money off the table would be one way which they could raise money to make these sorts of considerable investments in US AI infrastructure.
Okay, Bloomberg Intelligence senior analyst Robert Lee, we thank you for that analysis. But President Donald Trump also says that he's open to Elon Musk or Oracle's Larry Ellison purchasing TikTok as part of a joint venture with the US government. Lots of developments happening, of course, since Donald Trump has taken office. The social video app temporarily went offline over the weekend, but then the new president signed an executive order to extend the sale deadline by 75 days. So now the owner, ByteDance, has publicly refused to sell the business. Could we see that changing? The US president says as well that he's likely to impose sanctions on Russia if Vladimir Putin doesn't come to the table to negotiate on Ukraine. Donald Trump said during his election campaign that he could end the conflict in one day once back in office. On Monday, Putin said that Russia was ready for talks with the US, emphasising the need for a long-term peace based on respect for all nations' interests. So we shall keep across that as well. Meanwhile, Saudi Aramco's CEO has said that China is still powering growth in global oil demand, dismissing concerns about peaking consumption in the world's biggest energy user. We've been speaking exclusively to Amin Nasser in Davos, and that conversation began with a question about the impact on the latest US sanctions on Russian crude exports. Take a listen.
It's still too early. We understand from the news there is 186 tankers that will be impacted. The seaborne that comes from Russia is around 3.4 million barrels. The rest is piped. If you add to that approximately seaborne production or export from Iran of around 1.6 million barrels. So in total, you're talking about 5 million barrels per day. But for the Russian tankers that are impacted by the sanctions, the impacted tankers, the volume that you are looking at is close to 2 million barrels per day. So it's still at an early stage. We will wait and see what is the impact of all of these things in the markets. But we started to see tightening in the market.
Yeah. Have you seen any inquiries from Asian buyers to compensate for some of that anticipated supply disruption?
We do have a large customer base, and we have a target every month in terms of governed by the target that we receive every month from the Ministry of Energy in terms of how much we supply the market. The ministry, through their analysts and their work that they do every month, they always try to balance the market. So the targets are matching their view of what is required to balance the market.
But you would be able to provide extra barrels if asked?
Well, we do have spare capacity of close to 3 million barrels per day. So the upside for Aramco, depending on what target we receive, is there. We have the capacity. It's readily available, depending on the targets that we receive every month. But we have demonstrated in the past that that capacity can be brought to the market in a few weeks.
Do you think OPEC Plus will be able to bring the extra barrels back to the market this year without causing a significant shift downwards in the price of oil?
Well, as I mentioned, they do have their own analysts and they have their own view, and they are good at measuring the market and anticipate what would be required to balance the supply demand. And this is where the targets comes to Saudi Aramco and the rest of the OPEC Plus from their different agencies. But it is always looked at in terms of a way of what needs to be done to balance the market.
Let me ask you about demand signals that are coming through from Asia, from China. That was a big swing factor last year. What are the signals that you're seeing there in 2025? Well,
we're seeing still most of the growth that we are seeing coming from Asia, China, India, and the rest of Asia. There is growth driven by liquid to chemical, for example, in China, transport fuel, majority also going as a jet fuel. So that's where we are seeing the growth that is coming. But the majority of the growth that we are seeing is coming from Asia in terms of the demand.
It's interesting what you say about transport fuel in China, because obviously there's been a big shift towards the usage of electric vehicles. Analysts are saying that we're getting close to peak oil demand when it comes to transport fuel. What do you see?
I think in China, as I said, there is a huge growth even for electric vehicles. The liquid to chemical, our strategy is to go to 4 million by 2030, about 4 million barrels per day. A lot of it is going into China. China, why do they need the liquid to chemical as a feed? They need it because of electric vehicles. They need it for solar panels. They need it for carbon fibers. So my point, even for the transition and going to electric vehicles, you need oil as a feedstock to produce the material that would be required for any transition. So the growth is still there. Instead of producing more gasoline and diesel, they are using the feedstock to produce more chemicals. You see a lot of the conversion, the refineries in China, for example, a lot of the one that we are investing in right now, the conversion of liquid to chemical is at 60 to 70%, compared to an average of about 10 to 12% integration in liquid to chemical around the world.
Do you think the market was sort of overstating the state of demand that is coming out of China, and the fact that people have been so bearish about some of the signals coming through there?
No, we're still seeing good demand coming out of China. We've seen it in 2024. We still anticipate, as I said, most of the growth, the 1.3 million, 40% of that growth will come from China and India. The rest is coming from the rest of the world. As I said, China, even when you talk about their move into electric vehicles and renewables and all of that, they need feedstock to create the material that will be used in these electric vehicles and these carbon fibers and all of these things. So we are seeing the demand, and demand is increasing year on year.
Let's talk about another supply driver. President Trump is back. He made a lot of declarations yesterday, but one of the declarations he made was that the U.S. is in an energy emergency. And just to repeat what he said, of course, repeating the drill, baby drill mantra, but he said, we will export American energy all over the world. We will be a rich nation again, and it is the liquid gold under our feet that will do it. What is your response?
I think, the U.S. today is a net exporter. It's not a net importer when you come at the liquid. The 20 million plus million barrel of oil and liquid that is being utilized in the U.S., they export, based on our calculation, close to about 2 million barrels. So they are a net exporter today. At the end of the day, what you need an energy that is affordable, secure, and sustainable. And that's the pragmatic view that we need to see, because you need to ensure that all sources of energies are available, as long as you continue to decarbonize and avail energy that is affordable. And that's, I think, the U.S. will do what's the best interest of the U.S. in terms of maximizing the value of what they have in the subsurface.
Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai, where it's just gone 8:16. So we were just hearing there from the Saudi Aramco CEO telling our very own Jumana Bersetchi that he's not worried that Chinese demand is going to weigh on oil demand in the year ahead. Let's get another view now on the global economy. I'm joined by Simona Mocuta, who is Chief Economist at State Street Global Advisors. Good morning, Simona. Good to have you with me. Is it wishful thinking to expect that Chinese demand is going to sustain global oil demand, given the growth prospects for China in 2025?
I don't think it's necessarily wishful thinking, because China is not growing as fast as it used to, but it's still growing a lot faster than most developed economies, and it's very large. So as a contribution, you would expect them to actually be a big big driver of global demand. In that sense, I think it makes sense to make that argument. I thought it was very interesting as well to what we heard, this idea that, well, it may be coming from a different source and for a different end point, not the transportation of the past, but creating the transportation of the future. That is a different kind of demand, but still coming from China. So I thought there was a lot that was actually valuable there.
Yeah, kind of positive spin on the EV transition story. I'm also interested in your view on tariffs, though, because, of course, they're affecting the China outlook. How are you modelling that as we have so much uncertainty about what Trump's tariff policy will look like?
Really, the only thing we know for sure right now is that there is uncertainty. And I think it's very wise to not extrapolate too much. There is a huge difference between 10% and 60%. I would say, as a rule of thumb, something in the order of 10%, given the length and complexity of global supply chains, given exchange rate movements, it can pretty much be absorbed along the chain. So the inflationary, if you are looking at it, and I think the main concern around tariffs truly from the US standpoint is the inflationary impact. For China is, the growth impact. But for either side, in an environment of, say, 10% or sub 20% tariffs, that's something that you can by and large absorb and manage. When you get to really high numbers, it's a different story. But we don't know any more today truly than we did, a week ago in terms of exactly what and when we are going to get. So we are all in wait and see mode in that regard.
OK, that's interesting, though, because the market response to tariffs is a bit all or nothing. Do you think that that's too extreme? Because the tariff advocates would argue that, these are a revenue raiser, a negotiating tool, and they don't necessarily need to be inflationary. Is there value in that argument?
I think the market tends to overreact, and I think there's so many headlines out there, and for good reason, because there is news and considerations that we are thinking this and we are thinking that. But really, what matters is what you get, the size of it, the timing of it, and then how long are they in place? Because you could get even the 60% tariffs for a month or two. And the impact of something, an action like that on the macro economy will be different than if you had 30% for a whole year. So it's just so many moving pieces, and I think it's wise to actually not have too much of a knee-jerk reaction and extrapolate to infinity that this is what is going to be. And the other thing to remember with tariffs, again, we come back to tariffs from an inflation standpoint and what does it mean for the Fed and central banks and so on. Well, even if you have 100% tariffs, the inflationary impact tends to be a one-off. A year later, they roll off the base of comparison, and you kind of go back towards normal. In the meantime, you also have a demand hit. The bigger the number, the more likely that you have a negative demand shock from that exercise. So as a central bank, then you have the added challenge of asking yourself, how do I deal with a shock that I know is temporary in nature? Do I respond?
Yeah.
How does that influence my view on neutral rates?
Well, then, when you've got the likes of Ken Rogoff in Davos warning that the chances of a hike from the Fed as the next move are 50-50, is that too exaggerated in your view?
I would certainly not put a 50% chance on a Fed hike. And let me walk you through my thought process there. I think the odds of the Fed staying on hold are much, much, much higher than the Fed hiking. And part of the reason for that is that the Fed will not bother to hike for the sake of a single hike. It doesn't make sense. It doesn't truly change the picture at the macro level. So the Fed needs to get to a point where they feel it's not one hike that's needed, it's multiple hikes that are necessary. And I think to get to that point, the bar is very high. I certainly would not say 50%, more like 10.
All right, good to get your take. Simona Mocuta, Chief Economist at State Street Global Advisors. Thank you, as always. Markets now fully pricing 2 Fed cuts, a 50-50 chance of a third. But let's get back to our top stories right here in the Middle East. Israel's top general and his Gaza commander have resigned over the failure to prevent the October 7th Hamas attack. Their taking of responsibility may add pressure on Prime Minister Benjamin Netanyahu. Lieutenant General Herzi Halevi is to step down as Chief of Staff of the Israel Defense Forces in early March, around the time the ongoing 6-week ceasefire with Hamas is due to end. Israel has also started a major operation in the West Bank city of Jenin, adding to fears that attention is shifting from Gaza to the larger of the 2 Palestinian territories. The Palestinian Health Ministry says at least 7 people were killed in the raids yesterday and another 35 injured. The Israeli military confirmed the operation but provided no further detail. Well, coming up on the programme, our Davos lineup with key newsmakers continues, including the German Finance Minister, the Barclays CEO, the UK Chancellor of the Exchequer and the Nasdaq CEO, among others. There's plenty coming up, so stay with us. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. To some of our other top stories this morning, and no cause for celebrations in the world of pricey booze. Champagne shipments dropped for a second straight year in 2024 amid a broader slowdown in luxury spending. According to data from Comit Champagne, shipments were down more than 7% to their lowest since 2001, excluding the pandemic. Shipments within France, which consumes more than 40% of the global total, were the lowest since 1983. In other corporate news, Apple has lost its crown as the world's most valuable company after its stock closed at the lowest since November. The drop erased over $110 billion from the company's market cap, seeing it drop below chip giant Nvidia. Apple was hit by 2 broker downgrades due to weak iPhone sales in China and tepid consumer interest in its smartphone AI. And Netflix shares have soared in late trade after its biggest quarterly subscriber gain in history. The return of Squid Game and its first major live sporting events saw the streaming giant add almost 19 million customers in the fourth quarter. It's the last time Netflix will report quarterly subscriber numbers, though, as management attempts to get investors to prioritise on financial metrics instead, like sales and profit. Well, those are some of our top stories. Of course, we will keep an eye on Netflix shares later in the day. As I say, posting its biggest subscriber gain in history, shares rising more than 12% in extended trading. If that holds in regular trading today, it'd be a new record for the stock after a rocky start to the year. You're looking at Wall Street futures pointing higher and on Euro Stoxx 50 futures too, both about 0.2% higher. We're going to keep going with our oil conversation next, so do stay with us. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. AI investment. SoftBank soars after President Trump announces a pact along with OpenAI and Oracle, forming a $100 billion joint venture. China markets on edge after Trump says 10% tariffs on all China imports are still on the table and could start as soon as next month. And shares in Africa's biggest mobile operator, MTN, gain after Nigeria approves a 50% increase in tariffs. Those are your headlines. It's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai in for Jumana Basetchi. Very good morning to you. Welcome to the programme if you're just joining us. And it is clear as we look at these markets who is back in the driver's seat. It is, of course, Donald Trump. We've seen a boost to risk sentiment off the back of his AI policy, what we've had of it so far. Seeing that in the Asia session and futures stateside and in Europe pointing higher as well. We'll dive into that. We've also had a bit more on the Trump tariff front. 10% tariffs on Chinese imports looking likely. But you have seen the 10-year yield at 4.58% in the Asia session. Brent trading at $79 a barrel, weaker given the dollar's rise, and we'll get back into oil in just a moment. But if we flip the board on the tariff story, an excellent way of kind of monitoring the impact of Trump tariffs is this ticker, the UBS Trump Tariff Losers Index. And actually, you can see the relief here at the end of the chart in terms of the tariff policy on day one. But as we get more details, will this flip a little lower? We'll keep an eye on that. But let's get over to Asia now. Avril Hong's on standby for us in Singapore with a look at the AI-related stocks in Asia. Avril, over to you.
Yeah, Lizzie. I mean, we've been seeing how they're the ones that are really lifting the gauges in the region. The stocks of firms along the AI value chain, this part of the world, are going gangbusters, right? Thanks to Trump and how he unveiled this joint venture between SoftBank, Oracle, OpenAI, unlocking as well hundreds of billions of dollars in terms of AI infrastructure spending eventually, and lower guardrails than during the Biden administration. So, he's doing all he can to kind of make sure that the U.S. maintains its lead in China in the AI space. So what we're seeing in these stocks is that outperformance, particularly for Japanese AI-related names. We had some analysts from Otis Advisors saying this is pretty much a green light for all things AI, whether you're looking at data centers or cable makers. Furukawa Electric shooting up double digits, similar gains on Disco. This is a chip equipment maker, and of course, SoftBank. It's climbed by the most since at least August last year. So this is the picture, and I guess a reminder of Trump's influence as a driver on Asia equities as well. Lizzie.
Yeah, we'll keep an eye on the tech stocks in Europe as well as we head into the European session later in the day. But let's get back to the oil impact. Oil fluctuating after Trump revived his threat of tariffs on China, raising concerns over trade wars on several fronts. Canada and Mexico, of course, also in the crosshairs. Bloomberg Economics predicts that 5 themes are going to shape Middle East economies in 2025, and chief among them, of course, is the influence of geopolitics on crude supply. To dig deeper into this, I've got a fantastic panel with me in the studio. We have our Chief Emerging Markets Economist, Ziad Daoud, as well as our Middle East Energy Markets reporter, Anthony De Paula. Ziad, let me start with you. You've got a fantastic note on this. I mean, what was kind of surprising about 2024 was, I suppose, how little geopolitics actually disrupted oil prices. How much do you think that that's going to change with Trump back in the White House in 2025?
Good morning, Lizzie. I think it's already changed even before the arrival of Trump. So the story of oil at the end of last year was one of oversupply. Biden's sanctions on Russia changed the landscape in the market, and oil rallied after that. And now with potential maximum pressure from Trump on Iran, that could change the supply picture as well. But obviously the geopolitics is only one side of it. Tariffs can impact demand. And if drill, baby, drill works in the U.S. and you have more supply from the U.S., that could put downward pressure on oil prices.
Well, Anthony, let me pick up on the Iran point, because you've written that Trump could blow a $30 billion hole in Iran's economy if he does put maximum pressure on Tehran. How has that number been arrived at?
Yeah, well, let me walk you through that, Lizzie. We looked at some tanker tracking data, our own, that we do on Bloomberg, as well as some other agencies. There's one group in New York, United Against a Nuclear Iran. It's kind of a lobby group. It seems like it's close to the current administration on their advice for how to deal with Iran. They looked at the last 4 years of Iranian exports under Biden, came up with a figure of $140 billion worth of oil that went to China only over that period. We extrapolated that to look at the total amount of oil and then took off about 1 million barrels. That was the increase that came in Iranian exports over those last 4 years. Taking that out, that's roughly 2/3 of what Iran could be exporting. So we're going to take 1 million barrels off the market, and that's how we get to that $30 billion figure. It's roughly 2/3 of what that yuan figure was.
But do we have a sense of what maximum pressure is going to look like?
It's going to be more difficult than last time around. Last time when Trump came in and the Iran nuclear deal was still in place, Iran was exporting more than 2 million barrels a day. That dropped as low as 300, 400,000 barrels a day, depending on the estimates that you look at. Again, the difference won't be that big because simply only a million barrels have been added into the market. But it's going to be more difficult because Iran has gotten more clever about disguising some of its vessels, turning off transponders, and really also hiding some of those financial flows. So probably the Trump administration is going to have to look at the buyer, which is China in this case. Trump is looking at hitting China with tariffs anyway, so probably he'll be less resistant to do something that will hurt them on the point of cheap oil imports. So we might see some activity there as they try to target those exports.
Ziad, I know you said there's more to this than geopolitics, but if we've got the ceasefire in Gaza for now, are there particular other countries you're monitoring in case of instability when it comes to oil?
Well, the obvious one, look, one of the surprises of last year is the spread of the Middle East war beyond Gaza. So the ceasefire in Gaza does quieten that sort of spot for a period of time. But there are also hotspots that have, were involved in the Middle East war last year. You're talking about Yemen. You're talking about potential escalation between Iran and Israel. We didn't think last year that we'd have a direct exchange between Iran and Israel. And if that, happens, then that could present, that basically brings the war closer to oil fields that have the capacity of 30 million barrels a day, about a quarter of the global oil production. So that is probably a risk, and we'll have to see what happens this year.
And Nancy, it's interesting the point you make about Iran kind of trying to get around sanctions. We've seen Russia having to switch oil tankers to deal with the US sanctions as well. How much of a logistical nightmare and expense is that for Russia?
Yeah, well, exactly what we've seen in the oil price over the last couple of days when it did ramp up after those sanctions were announced was basically on logistics. Would buyers shy away from using some of those vessels that were specifically sanctioned? And so that means if a buyer's not going to take a vessel, you got to switch it in, bring another vessel. One of those issues that is affecting Iranian and Russian exports is simply the availability of vessels that will carry that oil. And if you've got fewer vessels that are willing to operate or vessels that can't have insurance, that means you've got to rely on your own fleet. And we've seen this in the Iran playbook throughout the last couple of years, and Russia's adopted a lot of that. New companies popping up kind of like mushrooms everywhere to take over ships, to do different trading. And now it's been very much a whack-a-mole kind of process over the years. We've seen that with both countries. That's going to continue. And that's why I say it's going to be a little bit harder to exercise these sanctions, because you need to find more clever ways to counter those clever ways which Russia and Iran have used to disguise their exports.
It's really fascinating how they're learning from each other. Chief Markets Economist Ziad Daoud and our Bloomberg Middle East Energy Markets reporter Anthony De Paula, thank you both so much for joining me. So that's the outlook for oil for 2025. But in other news this morning, the BNY President and CEO Robin Vince says that artificial intelligence, is going to have a fundamental impact on the world. He was speaking at a banking panel in Davos, moderated by our very own Jemana Basetchi. And Vince went as far as to make the comparison to major innovations from the 19th century. Take a listen.
Some people use the invention of the phone or the internet. I actually go back to electricity. I think it is as fundamental as that in a lot of different ways. Number one, there's a bedrock capability here which is going to enable a lot of builders to create super interesting things. And I think many of the things that are interesting are things that are even hard to conceive of today. Just as the folks who first really promulgated electricity commercially had the light bulb in mind, they probably didn't imagine so many of the other inventions that would follow. In our industry, we're an industry of knowledge work. And AI really is an intelligence machine that will ultimately create leverage for humans, where we will have agents, digital employees, as we think about them now in our company, who are going to work as part of the workforce, doing tasks, creating capabilities, helping us to push forward faster than otherwise we would. And so I'm very enthusiastic about what AI will ultimately do, and I think it will bring a lot of positive development. But you pointed out an important point, which is we're going to have to manage through the important impacts that it's going to have on workforces, and we're going to be able to hopefully enjoy the productivity benefits that it'll have over a longer range period of time.
Mary, is AI a game changer?
Absolutely. I mean, we are in the most fundamental change across all industries everywhere in the world. And actually, some of the greatest beneficiaries are going to be the countries that haven't been able to keep up in the past, and they can leapfrog and go forward. If you're curious and you move fast, you're going to win here. And so you think about, we spend $18 billion on technology every year. We are plowing that into investments across the board. We already have 200,000 employees as active users of AI on a daily basis inside of JPMorgan. And what I can't show you, and frankly, I don't need to or want to show you, is that the savings that that's creating about taking away all the things that we just talked about for the first half of this panel, all the no joy work. First, you eliminate that. Then you get on to helping the client, giving them more insights, protecting them better, recognizing patterns that the human eye can't see, being able to stay ahead of the bad guys, and helping all of the CEOs that I see in this audience to help win and move faster. And so you look at that and you say to yourself, this is an incredibly exciting time. What it doesn't necessarily translate itself into is to job cuts, as you referred to, because most of the CEOs and companies I see here, and particularly on the panel, are in growth mode. And so I can't disprove the negative. I can't tell you I didn't hire those next 5,000, 10,000 people, but we're not. We don't have to hire those net new people. We can keep who we have. We can reinvest in them. And if they go along the journey with us on this AI very exciting time for the world, they will all be endgame winners. And the clients, the end user, will have a much, much more just powerful experience. Everything will be hyper-personalized to them. It will be in the banking system as if they're walking around with their own CFO right next to them.
What a lineup. Banking chief speaking with our very own Simona Mocuta over in Davos. We'll have plenty more from Simona later in the programme, but up next we're going to go to Africa. MTN Nigeria shares surging after the government allowed telcos to lift tariffs for the first time in 12 years. All the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now to Africa, MTN Nigeria's shares surging 10% after the Nigerian government raised telecommunications tariffs by 50%. The adjustment, the first in 12 years, is half of what companies had asked for in an attempt to weather the harsh economic conditions. Let's get more details now with Bloomberg's Ondiro Oganga. She joins us from Kigali, Rwanda. Ondiro, what did it take for the telcos to get the Nigerian Communications Commission to hike tariffs?
Hi, Lizzie. So at Summit tap into tough economic environment. If you look at the country, it's been going through a really tough time. Inflation has hit a 30-year high in November 2024. It clocked at 4.6%. The currency has also been having its own challenges. The naira depreciated by about 41% to the dollar in 2024. And this just means that the prices of goods went up, but also these telcos suffered huge FX losses. And we've seen previously these telcos try to hike rates, but the Nigerian Commission was there to strike that back. And in their defense, these telcos are saying that if they're not able to have prices that reflect the current economic situation in Nigeria, then industry sustainability is going to be very hard. So following this rate hike, we are seeing the Nigerian Communication Commission say that it will go into improving investment in the industry, like innovation and also building of infrastructure.
Well, yeah, with inflation at the heart of the political story around the world, what's this going to mean for end users? What benefits as well are telcos likely to reap from the increment?
Lizzie, like you said in the beginning, we have seen MTN shares surge 10%, and it was trading at 256.30 naira. And this is the biggest surge that it has had in over a year. And also you have Ascalon Capital saying that despite the fact that 50% is less than what they were asking for, it's still more than the 10 to 20% that they had factored into MTN's earning for this year. And so for the first 2 or 3 months of implementation, there's likely to be a negative effect, but it should be able to support medium-term revenue growth of over 30%. Other benefits include increasing base stations, expanding 5G rollout, and also increased capital expenditure. For the end users, they're likely to grapple with higher prices in the short term, which could lead to inflation. But also, telcos could invest in improving the quality of service, which will increase productivity and in the long run offset the impact of inflation.
OK, Bloomberg's Ondiro Oganga, we thank you for bringing us that story. But coming up on the programme, the UAE objects to the EU keeping it on a blacklist of countries with deficiencies in combating illicit money flows. We'll get more on the Economy Minister's comments next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. And right here, the UAE Economy Minister has expressed concern that the European Union is keeping it on a blacklist of countries with deficiencies, tackling money laundering and terrorism financing as well. He's been speaking at Davos, Abdullah bin Tuq Al Mari, saying he doesn't understand how the UAE is still on this list. Well, let's dive into this more with Bloomberg's Abir Abu Omar. Abir, thanks for being with me on the set. I mean, I'm trying to work out how significant this is for the UAE.
I mean, quite significant, Lizzie, right? So the backstory to this is the UAE was added into the FATF's so-called grey list a couple of years ago. Now, it exited this list last year. The UAE had scored those due diligence points and was working closely with the commission in charge of the FATF committee to sort of exit that list. Now, a direct consequence of exiting that list is exiting the EU's blacklist. The UAE hasn't exited the EU blacklist, and that's why, the government here has expressed concern in the past. But yesterday, speaking to the UAE's economy minister in Davos, he was definitely concerned about that, but also other things that the EU has been doing, and that's, the EU's new directives on sustainability. And he voiced his opinion on why that, why those directives, why those laws don't necessarily work in the benefit of countries, in the Gulf region like the UAE, Saudi Arabia, Qatar.
But I mean, it's not just the UAE questioning this, right? You talk about Qatar. They feel unfairly treated too, right?
Correct. I mean, Qatar went as far as saying they're going to vow to stop gas shipments to the EU if the EU takes too seriously those directives that they passed on last year about, for big corporates doing business with the EU to, be careful about their supply chains and not have supply chains that are in the midst of, doing any sort of work with forced labor or anything that is environmentally damaging. So, Gulf ministers are quite taking this seriously and voicing their opinions in Davos. And previously, again, Qatar's energy minister has said that Qatar may very seriously vow to stop gas shipments.
So to be clear, what's to be gained if they come off the blacklist?
So it's a reputational thing, right? The UAE, the grey listing on the FATF list was the main thing. The UAE has already exited that. We've written, multiple, so we've traced that stories for a good, year and a half, 18 months to try to look at, what was the impact on the ground. So exiting the grey list is really all the UAE wanted in terms of bringing in, the money and the due diligence processes to be, to go back to what they used to be. But the blacklist, the EU blacklist, reputationally, it doesn't look good for any country to be on, a blacklist. But in effect, all the UAE needed was to get out of the grey list, which it already did. And, I think the timeline that we have for this year is, I want to say, second quarter for the UAE, for the committee to look back at the blacklisting and possibly weigh options to remove the UAE.
Well, your concern has been noted, Minister. Let's see if the EU's listening. Abir Abu Omar, thank you for the update. Now, let's get to some of our other top stories that we're following for you this morning. Turkey has declared a national day of mourning after a fire at a hotel in a ski resort killed 76 people. At least 51 were injured in the blaze, which broke out around 3:30 a.m. on a restaurant floor of the Grand Kartal Hotel in the resort of Kartalkaya. The fire quickly engulfed the rest of the 12-storey building, taking around 10 hours to control. In other news, ArcelorMittal's plans to shut down a century-old steel mill in South Africa are holding President Cyril Ramaphosa's dream of an infrastructure boom to ransom. The plan, and two others it wants to idle, supply what builders need for the rollout of power transmission towers, rail lines and new roads as well. Ramaphosa says that he wants to turn the country into a construction site. And Congo's army says M23 rebels have tightened their stranglehold over key trading routes to the city of Goma in Eastern Democratic Republic of Congo. The rebels have been expanding their territory with the help of soldiers from neighbouring Rwanda. The fall of the town in Minova puts the militia within 40 kilometres of Goma along the Rwandan border. And Goldman Sachs is promoting a slate of star executives to run its biggest Wall Street business lines, showcasing the firm's next generation of leadership. The bank, which just reported a surge in profit, is tapping new global leaders for its equities, fixed income and banking units. It's also named new co-heads of the international unit and dramatically expanded the management committee. And elsewhere, Bloomberg has learned that Brevin Howard Asset Management has cut about 7% of its trading workforce after two of its main hedge funds underperformed relative to peers last year. The cuts affect roughly a dozen traders in offices globally spanning New York, London and Abu Dhabi. Brevin Howard joins rivals such as Bridgewater and Two Sigma in trimming headcount after what has been a rapid period of growth. Well, those are some of our top stories this morning. Just checking in on these markets as we inch towards the end of our first hour of Horizons. We have futures pointing higher stateside. S&P E-mini futures up 0.3%, about the same for Euro Stoxx 50 futures. This risk-on mood as we digest Trump's policy filtering around the world. Stay with us. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. AI investment. SoftBank soars after President Trump announces a pact along with OpenAI and Oracle, forming a $100 billion joint venture. China markets on edge after Trump says 10% tariffs on all Chinese imports are still on the table and could start as soon as next month. And shares in Africa's biggest mobile operator, MTN, gain after Nigeria approves a 50% increase in tariffs. Those are some of our top stories this morning. Good morning. It's just gone 9 a.m. across the Emirates. I'm Lizzie Burden in Dubai.
And I'm Jennifer Zabasaja in Johannesburg, where it's just gone past 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. And Lizzie, a lot of market-moving news. Of course, you mentioned the AI news we got there. There is, of course, the Netflix earnings. So a lot that we're paying attention to and that investors are watching closely this morning.
I definitely feel like I helped Netflix out with all my binge watching over the past year, Jen. We are going to keep an eye on the Netflix impact at the open on Wall Street. We have futures pointing higher stateside, 0.3%. As you say, we're also getting this boost from Trump's AI policy, feeling that in the Asian session, and we're looking for gains of 0.25% on Euro Stoxx 50 futures as well. We've got the 10-year US Treasury yield at 4.5%, Brent at $79 a barrel, so pretty steady. We did see losses yesterday on the dollar's rise as we digest the Trump effect. And if we flip the board, you can see more of that impact actually on what we have gathered as the Trump Tariff Losers Index. This is made by UBS. And you can see here the relief actually off the back of that day one lack of Trump tariff policy, really, but a bit of a reversal perhaps coming now that he says he could slap China with a 10% tariff next month. Definitely a ticker that you want to be keeping an eye on. But let's go to Asia now. Avril Hong on standby for us in Singapore with a look at how markets are faring there. Avril, over to you.
Yeah, Lizzie, we're seeing a mixed bag. This continued recalibration to Trump among Asia equity markets. And we're seeing how AI-related stocks are really doing very well today as he unveiled hundreds of billions of dollars eventually on spending for the sector, lower guardrails as well. So we have the likes of SoftBank, the big boost for the region's benchmark, climbing double digits by the most since August last year. And then you have AI construction-related stocks as well, I should say, that are tracking the gains confidence in their US, Europe counterparts amid expectation of more infrastructure, nuclear power spending. China today is the market that is really underperforming, and this is after Trump reiterated that these 10% tariffs on all China imports, they're still on the table. I would just highlight, as some have pointed out as well, that this follows on from a string of gains for Chinese stocks, so maybe they were due for a breather anyway. And at 10%, they're still not as bad as the 60% that was previously floated for some of these Chinese tariffs. So keep that in mind, even as we see declines in Chinese stocks as well as the currency today. Guys.
Okay, an interesting dichotomy between the fate of China equities this morning and the rest of Asia. We thank you, Avril Hong, over in Singapore. And let's dive in more deeply to that AI policy story. SoftBank, OpenAI, Oracle, all forming this $100 billion joint venture to fund an AI infrastructure program in the US. President Trump unveiled the initiative called Stargate, which is aimed at speeding US development of the emerging technology. We can get more now with Bloomberg News desk editor Jill Deesis. She joins us now for more. Jill, is this initiative actually new, or is it a Trumpified version of what was already there under Joe Biden?
Well, Lizzie, I think that this is pretty significantly different in really one key aspect here when you're looking at the policies that the Biden administration was pursuing toward AI versus the Trump administration. And that really comes in more of this removal of guardrails and sort of paring back of regulation on the AI industry. So I think it was the case that under the Biden administration, what you saw was a little bit more caution when it came to actually how to regulate AI. Obviously, there's a lot of really big, weighty, in some cases, existential questions about how exactly you pursue this technology, what exactly it means, what exactly sort of introducing this actually means to the world. And I think, obviously, like there were still, I think, some conversations going on with that during the Biden administration. I mean, this is something that we've really only seen take off within the last couple of years, particularly after that sort of introduction of OpenAI's ChatGPT program. I think what you're seeing with the Trump administration, though, is they're very much more sort of like pro-business in the sense that Trump seems to want to remove some of those guardrails. This particular initiative, we're still waiting on a few details about, but it does seem like the idea here is it's this $100 billion investment involving OpenAI, involving SoftBank, also Oracle as well. There's some targets to sort of balloon that out to $500 billion worth of investment. Maybe Microsoft and NVIDIA get involved there, but it does seem like it's much more in line with what a lot of these Silicon Valley executives want, which are less guardrails on this system so that they can really sort of ramp this up and ultimately, I think, compete with China, which is obviously targeting AI-related initiatives very aggressively as well.
Yeah, well, Trump, of course, reiterating his threat to slap 10% tariffs on all China imports. Avril was talking about the impact in the markets this morning. China says it's going to import more. Jill, do you think it's fair to say that this is still a surprisingly warm start to the US-China relationship?
Yeah. Maybe, Lizzie, although I still think we need to kind of, pare back from making any kind of like overarching judgments about what this says about the U.S.-China relationship. Maybe it's surprising in the sense that you would have expected Trump to say day one that there's going to be X number of tariffs on China. Now, obviously he's saying this 10% increase maybe as soon as February 1st. But at the same time, I kind of wonder how much of this is Trump rather, taking, for as Trump as this gets, maybe even taking a bit of a calculated step to get people like Marco Rubio, Secretary of State, Scott Bessent, the nominee for Treasury Secretary there, involved in some of these conversations about how exactly you treat China. I mean, it's very fair to say that, Trump went pretty hard on the idea of raising tariffs on China to, as much as 60% on that campaign trail. So I really wouldn't discount the fact that this could be a relationship. These could be tensions that flare up. I think we've seen indications from China that they want to kind of smooth things over. They did send pretty high-ranking representatives to his inauguration, but we'll have to see what happens.
OK, crucial context. Bloomberg News desk editor Jill Desis, we thank you for that. But of course, there has been a slew of other announcements from President Trump. He says he's open to Elon Musk or Oracle's Larry Ellison buying TikTok as part of a joint venture with the US government. The social video app temporarily went offline over the weekend before the new president signed an executive order to extend the sale deadline by 75 days. Now, owner ByteDance has so far publicly refused to sell the business, but we should keep an eye on that. Over to you, Jen.
Absolutely, Lizzie. Yeah, let's get to what's happening in Davos. Aramco CEO says China is driving growth in global oil demand. Amin Nasser told Bloomberg that despite concerns about peaking consumption, demand from China will continue to increase year on year, driven by the country's appetite for chemicals produced from oil.
We're still seeing good demand coming out of China. We've seen it in 2024. We still anticipate, as I said, most of the growth, the 1.3 million, 40% of that growth will come from China and India. The rest is coming from the rest of the world. As I said, China, even when you talk about their move into electric vehicles and renewables and all of that, they need feedstock to create the material that will be used in these electric vehicles and these carbon fibers and all of these things.
Let's get over to Davos now and speak to Bloomberg's Simona Mocuta, who brought us that fantastic conversation. Simona, great to have you. You did speak with the CEO. What more did he have to say with regards to the oil market in 2025?
Yeah, morning, ladies. Well, it's not that often that we get a chance to speak to Amin Nasser, the CEO of Aramco, and obviously the world's largest state-owned oil fund. So really interesting person to talk to about oil market dynamics heading into the rest of this year. And I started off the conversation with him by simply pointing out, if we had had this conversation a couple of months ago, my starting point would have been a lot different because Brent, of course, was trading a lot closer to $70 then. Over the course of the last couple of months, there's been more geopolitical risk premium priced in. And when I say geopolitical risk premium, here I'm referring to specifically the sanctions and anticipated sanctions, perhaps that could come through from the Trump administration. Earlier, well, a couple of weeks ago, one of the last decisions the Biden administration took was to start applying sanctions on Russian exporters, tankers, producers. And so that led to an uptick in the price of oil. I started off by asking Mr. Nasser how he sees the market. And he said he actually sees it pretty balanced. And the signals, he said, coming through from China are still pretty robust. You may recall one of the reasons why oil was trading so subdued last year was people's bearishness about the Chinese economy. And of course, we did get that big fiscal push towards the end of the year. He is saying that out of the 1.3 million barrels per day demand growth that they see next year, 40% of that is expected to come from China, and namely on back of their demand for petrochemicals as well. But we didn't just talk about that. We also spoke about the number one issue people talk about in the context of Aramco financials, and that is the dividend. Take a listen.
What we told our shareholders that whenever there is the market is right, we are and the prices is right, we will look at our free cash flow that we have, pay from it whatever required in terms of external investment, base dividend and progressive dividend, and the rest, 50 to 70% of that will go to the shareholders. So as in the chemical, always it's a cyclical market, depending on the market and what will happen. What the promise is, based on board approval, is 50 to 70% of the free cash flow after you take from it the base dividends and the external investment will go to the shareholder. Don't forget, the upside for Saudi Aramco is there.
Yeah.
We are investing big time in gas, in chemical. We are positioning the company for the future. The other thing that is the most important, we have 3 million barrels of spare capacity readily available to go on the market when the time is right, based on the target that we receive from the Ministry of Energy.
But that 50 to 70% number of free cash flow, if free cash flow is negative, doesn't get paid.
Well, so far we have a track record. Everybody talked about Saudi Aramco. When we talked about the $75 billion, we had established a track record. As I mentioned, the $75 billion, and we went through the 2020, if you remember, the 2021, the pandemic and all of it. track record is the best thing when you look at Saudi Aramco. We generate value to our shareholders.
Yeah.
We are positioning the company for the future. You look at our capital. Gas is expanding by more than 60%. Placing it in the right market, we're generating double-digit rate of return by placing it in the kingdom. We are placing our barrels upstream in the right market with liquid to chemical conversion capacity. We are investing heavily in AI, in renewable, in all of these things, and we are putting the capital while being able. For example, the guidance last year is close to $48 to $52 billion. We reduced it. It was 48 to 58, and then we narrow it down 48 to 54 or whatever. But we are putting the capital, investing for the future in the different segments, in gas, in liquid to chemical, in digital, in renewable, in hydrogen, in LNG. So the company is going to be well positioned for the future. And we were able, with all of these huge capital investment over the last couple of years, to pay our dividend. So we established a good track record in terms of being able to pay our base and progressive dividend in the past.
Just finally on that point, the dividend has been a huge source of revenue for the Saudi government. Could we expect to see more borrowing out of Aramco to continue to pay that dividend towards that would service the state?
I think if you look at our gearing, it's in the low side. We always look at how much we can generate value by our bonds or sukuk or whatever. But at the end of the day, if you look at our gearing is around 2%. So we have low gearing, and we are balanced in terms of how much we borrow to ensure that we have a balanced portfolio, maximizing value to our shareholders, while, as I said, executing in our capital program, which is going to deliver value, because you are at the early stage executing all of these mega and giga projects that we are doing across the world, in the kingdom. That is going to generate value to our shareholder over the long term.
Now, the background to that conversation, of course, the fact that many analysts are out there are saying that Aramco's free cash flow pile is getting smaller, narrower and narrower, and some people are anticipating that it's going to turn negative, and therefore they will struggle to pay out the performance-linked dividends. Amin Nasser is saying that their track record speaks for themselves. So when I asked about the potential for borrowing, he did say that their gearing is low. So it sounds as though they do have the potential to go to the markets if they do want to continue to honor that dividend. That's obviously my words, not his. And remember, and this is the most important thing, it is an extremely important source of revenue for the Saudi government, part and parcel of the broader conversations we've been having with the Saudis here about their spending plans.
Great work from you and the team there in Davos. That's Bloomberg's Jumana Bersetji in Davos for us. Jumana, thanks so much for joining us. Now, coming up, we have more on the show. Stick with us. This is Bloomberg. Optimism over more AI spending under President Trump has offset fears over China tariffs. Most of Asia, as you can see, is in the green, but Chinese shares are being hurt by a mix of macro and micro factors. Joining us is Isaac Poole, Chief Investment Officer, at Ascalon Capital, joining us from Tasmania. Thanks so much, Isaac, for joining us. Let's just get your sentiment on Chinese assets right now. Do you expect more volatility to continue, and where do you potentially see the opportunity then?
I think there's certainly going to be more volatility, and part of that's going to be linked to the uncertainty around tariffs. I think the will he, won't he sentiment that we're seeing at the moment on whether or not the threat of tariffs is just a negotiating tactic or something that's going to be implemented just means we're going to see gyrations in the market over the near term. And I think this isn't a case of all bark, no bite. I do think we'll see tariffs, and that's going to be a challenge for Chinese equities, even though they look reasonably valued. The prospect for real tariffs being implemented could be a challenge.
What does that mean for your positioning, Isaac? Do you stay away and perhaps, focus instead on the U.S. and tech in particular?
I think while China looks like there's some relative valuation there, there's just not a real clear catalyst to go overweight. So for those investors who have an exposure to China, we wouldn't be looking to add at all. And more broadly in global equities, we think things look a little bit stretched, but there's this US exceptionalism that just keeps on delivering, certainly delivered in 2024. It looks likely to persist through 2025. So that means being overweight US equities still is probably the way to go within a slight underweight to global equities within a portfolio.
But Isaac, how much further can that exceptionalism really continue?
I think it's going to come under some challenge this year because we have seen growth top out. Even people who are expecting reasonable growth this year are expecting it to slow. We think there's a risk that it slows even further and that inflation does come in a little bit more, meaning that nominal growth could be well below expectations. And if we do see that negative surprise on nominal GDP growth, it's going to feed through to earnings growth. And markets are pricing in a big re-acceleration in earnings growth this year, and we just don't see what the catalyst will be for the broader index. And that introduces some downside risk when valuations are at such a stretched level right now.
Isaac, do you then potentially look to small caps or elsewhere globally, other markets, to then find other opportunities?
I think you've got to be really careful because for small caps in particular to really deliver, I think you're going to need significant rate cuts, and that's only going to be delivered if the economy slows, and that's not a great environment for smalls. Perhaps you could go down to mids, but we think the opportunity is to look outside of equity markets, take a couple of years of 20+% returns, lock away some profits, move a little bit underweight, and then for an investor in a diversified portfolio, look for opportunities that are undervalued. And for us, we think that's government bonds, especially with US Treasury yields banging back up at above 4.5%. That looks attractive to us, good downside protection, good income, and an opportunity to build a bit of resilience in portfolios.
Isaac, I want to end on the BOJ because we're waiting for the decision later this week. Potentially we get a dovish hike or a surprise pause. How is that potentially going to impact your portfolio and your positioning now?
I think we'll get a hike, but the scope for the BOJ to hike a lot this year is just dwindling away. I think growth will slow. They're going to struggle to get rate hikes up. And I think the risk is for Japan's economy to slow alongside the global economy. And so those big gains that we saw as people moved overweight Japan over the last couple of years could unwind. And we think it's an appropriate time to take some risk off the table in Japan and perhaps move to a slightly more defensive positioning.
All right, we're going to have to leave it there. Really appreciate your insights, though, this morning. Isaac Poole, Chief Investment Officer at Ascalon Capital, joining us this morning. Thanks so much.
Well, Jen, I want to pick up on the central banking theme and head straight back to Davos because Israel's central bank governor says that the country could see higher economic growth than forecast if the ceasefire between Israel and Hamas paves the way to a more sustainable regional agreement. Amir Yaron was speaking to Bloomberg's Lisa Abramovich at the World Economic Forum. Take a listen.
We just had an interest rate decision with a forecast which already took into account that basically after the first quarter will be on what's called just ongoing security with intensity of fighting substantially coming down. And we expect the growth rate for Israel for 2025 to be around 4%, and in 2026, 4.5% under that scenario. Now, obviously, we want to see all the hostages come back, and I hope the ceasefire is even a bigger turning point in the sense that we'll see after this horrible 7th of October day and the suffering on both sides sort of go away. But this can pave the way to regional arrangements. And if they are sustainable, they can facilitate rehabilitation, and they can, if they are provide sustainable security arrangement, they will promote growth, economic growth, and not just for Israel. They will promote growth for the region at large.
It sounds like you're skeptical that this really marks the end. it sounds like you're preparing, at least in terms of the economic outlook, for this to be maybe the end in extreme ongoing hot war scenario, but that the ongoing conflict isn't going anywhere for a while.
I'm not a military expert, but you know, our baseline scenario already incorporated the intense fighting is going to come down in the first quarter, and we're going to have sort of perimeter ongoing security. But the more there is ceasefire, and obviously I'm elated about the hostages that already came back, and we hope all of them will come back, to the extent that that paves the way to more sustainable regional arrangements. And hopefully they can be backed by powers from the US, Europe, and others in the region. That will provide both security, it provides certainty. We know that economies want certainty, they don't like uncertainty. That by itself will promote growth. It will certainly help Israel, and if that's the case, might have growth even higher than the numbers that I've just advocated, but it'll help the region at large.
So that was the Israeli central bank governor speaking to Lisa Abramovitz at Davos. Meanwhile, back home in Israel, the top general and his Gaza commander have resigned over the failure to prevent the October 7th Hamas attack. Their taking of responsibility may add pressure on Benjamin Netanyahu, the Prime Minister. Lieutenant General Herzi Halevi is to step down as Chief of the Staff to the Israel Defense Forces in early March. Around the same time, the ongoing 6-week ceasefire with Hamas is due to end. Elsewhere in Israel, it has started a major operation in the West Bank city of Jenin, adding to fears that attention is shifting from Gaza to the larger of the two Palestinian territories. The Palestinian Health Ministry says at least 7 people were killed in the raids yesterday and another 35 injured. The Israeli military confirmed the operation but provided no further detail. Well, those are some of our top stories in the markets. As we head towards the open, we have futures pointing higher on both sides of the Atlantic this morning. It does seem that Donald Trump's back in the driver's seat, his pro-AI policy boosting risk sentiment this morning. We'll have plenty more from Davos next. Stay with us. This is Bloomberg.
This is Horizons Middle East and Africa. Our top stories this morning. AI investment. SoftBank soars after President Trump announces a pact along with OpenAI and Oracle forming a $100 billion joint venture. China markets on edge after Trump says 10% tariffs on all Chinese imports are still on the table and could start as soon as next month. And shares in Africa's biggest mobile operator, MTN, gain after Nigeria approves a 50% increase in tariffs. It's just gone past 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Lizzie Burden in Dubai, where it's just gone 9:30 a.m. Welcome to Horizons Middle East and Africa. And Jen, it seems like these markets are still digesting all of the Trump policy that we've been getting so much in just the first couple of days.
I know, and I expect that to continue, Lizzie, as do markets, I think, for the most part. Listen, we did have the first full day of the new Trump administration, and as you mentioned, investors are still digesting a lot of what's to come and what he is saying. But if we look at U.S. equity futures right now, tilting higher ahead of the open later today, we did see on Tuesday, it was largely a positive, upbeat day for Wall Street. We did see most of the indices closing in the green, supported, of course, by that more bullish tone on AI. We also got those Netflix record earnings, so potentially some upside for equities to come. When we take a look at the U.S. 10-year, we are seeing yields tick up ever so slightly right now at 4.59%. But on Tuesday, we did see yields falling 5 basis points just a bit. So again, still reacting to some of that news that we're getting out of Trump, as is Bitcoin, as you can see on the screen right now, down more than 1%, but did spike over $109 $79,000 earlier in the week before settling down now just about $105,000. Brent crude stabilizing at just around $79 a barrel. And also another asset potentially or looking like it's having a strong start to this new Trump administration is gold. If you take a look at it, it's holding near its highest levels since early November. As these tariff threats intensify, perhaps investors are looking to more haven assets. And yesterday we did actually see bullion surge more than 1% right now. That is just a look at what we're seeing with gold over the past year. Let's take a look, though, closer at what's happening in our China markets. Avril Hong is standing by in our Singapore studio. Avril, what are you watching?
Well, as you say, with those tariff threats intensifying, that's really played out for Chinese equities today that are underperforming when the rest of the region is sort of riding this AI wave. CSI 300 is down, and this is against the backdrop of Trump saying 10% tariffs on all China imports. They're still on the table, and he kind of tied this with the fentanyl that's entering the U.S. via Mexico and Canada from China. I thought I'd put things into further perspective for you. So this chart, courtesy of MLife Sangwoo Park, shows you that actually when you look at the Bloomberg Fear Greed Indicator, yes, the sentiment is still bearish for the CSI 300, but it's actually eased off. So a signal, suggestion that maybe some of the extreme fears of a full-blown US-China trade war, maybe that has eased off a little. Of course, we're talking about Trump here, so everything could quickly change from a late-night social media post. And, the only thing we can really be sure of is the volatility. So some things to keep in mind, even as we see the losses in Chinese equities today.
Absolutely, Avril Hong. Day one, we should point out, for the Trump administration. Great to get your perspective there in Singapore. Let's cross back over, though, to Davos. JPMorgan says it has deployed teams working overtime to analyze the impact of the early outlines of the policy shift under U.S. President Donald Trump. Speaking on a panel in Davos, the bank's asset and wealth management chief, Mary Erdoes, said the Trump administration is creating what she described as a very pro-business environment and that the U.S. economy is in, quote, go mode.
The last 24 hours are just showing that there's going to be a lot of changes that we all have to digest. At JPMorgan, we have a war room set up to analyze and evaluate each and every one of these. So they've been up all night and are working on it. And I think that, time will tell.
Let's go back to Davos and bring back in our very own Jumana Bersetchi. Jumana, that was another fascinating discussion that you had yesterday. And so many of the themes that we're seeing around Davos are around Trump and these new policies. Talk to us about what some of the reaction is, though, from the people that you're speaking with.
Yeah, well, you just played a little bit of sound from the panel that we did yesterday, that banking panel. Really strong comments there from Mary Erdoes, who runs JPMorgan Asset and Wealth Management business, saying it's go time, essentially. And this is the feedback that I'm getting from most of the U.S. executives that we've spoken to around here. People are really excited about what the next year is going to bring. They think that the Trump administration is very much pro-growth, pro-business. But then one sort of element of concern has been whether there's already too much baked in, as in the forward path of all of these measures that the Trump administration is going to take may be already discounted in the market. So there is a question over valuation here, of course, as we've been talking about in markets. But I think one of the other developments is, say, from a green and an energy transition standpoint, over the years, and I've attended several Davos events, there has been a lot of focus on what the world is doing to help and aid with that energy transition. And the fact that one of the first decisions that President Trump took was to pull out of the Paris framework was a bit of a blow to anyone in that space. I asked Standard Chartered CEO Bill Winters about that on our panel yesterday. Take a listen.
Importantly, I think while there's been a clear shift in narrative, in particular in the U.S., also some other places, as far as I know, no banks have withdrawn their commitments to supporting a transition to a net zero economy. Nor have any of the large oil-producing countries, obviously Qatar being one, who's got a fantastic sustainability program, because in the long run, it's pretty clear that we need to disgorge ourselves from the reliance on fossil fuels. But when we set this up at Standard Chartered in the beginning, it was two prongs. One was we've got to do our bit to do the right thing. vis-a-vis our clients because they want to transition to a net zero environment, but it requires massive investment. That's what we do. We come up with those dollars. But two is we make money. Right? It's a big business for us, and we made we gave the guidance externally a couple of years ago that we'd make $1 billion of income by 2026. We'll be pretty close to that in 2025. It's just a big business, and it's a profitable business. So I don't want to sound too mercantilist about it, but we do the right thing and we get paid for it. It's kind of win-win.
Yeah. Mary, I don't know if you want to weigh in on that and whether you think that the requirements that have been put on banks have been a lot and too onerous. And to Bill's point, it doesn't necessitate you actually being part of an alliance for you to stick to climate commitments.
Absolutely not. I mean, I think on the climate front, everyone wants a green planet, and so we're all working towards that. But you have to have energy security, you have to have proper energy transition, and you have to have public and private partnership, and all of us are working towards that. We don't need different bodies of people to come together to tell anyone that. Our clients ask us to do that. We're one of the largest financiers of the green economy. We finance 1 in every 4 deals. We would do more if the other people on the panel weren't so competitive with us. But it's very important that we all invest.
The background to that there is, of course, many of those U.S. banks have actually pulled out of that net zero alliance, the climate alliance. But JPMorgan was one of those banks, by the way, and that was Mary reiterating that they're going to stick to their commitments. They just don't have to be part of a formal alliance. And they're very committed to continue with green lending. So lots of conversations being had here on green energy, on the return of Trump, on geopolitics. Also, artificial intelligence has been a major theme. As you can imagine, the theme this year is collaboration in the age of intelligence. But I also just want to flag, I've got another major panel coming up today about the future of interest rates. So this one is going to be a fun one, given all of the news that has come through over the course of this week and the pricing or repricing, I should say, of interest rates that has occurred over the last couple of months. So I've got the likes of Nicolas Tangent, the Norges Investment Bank, so the Sovereign Wealth Fund head, Villeroy du Gallo, and a bunch of other names. So watch out for that. We'll see what they say about the future of interest rates and where they're going.
Really looking forward to that. And again, Jumana, great stuff there in Davos for us. That's our Jumana Bersetchi in Davos. Now, coming up, Zambia is looking to deepen ties with oil-rich Gulf nations. We'll discuss details on the country's plan to quadruple copper production. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now, we've had a recent trade pact between Kenya and the UAE. We've also got Zambia looking to deepen ties with oil-rich Gulf nations. A lot of interest in this relationship between Africa and the Middle East. And we can speak now to an expert on it. We have Runa Alam, who's co-founding partner and CEO of DPI. She joins me in the studio. Really good to have you with me, Runa. I just really want to ask why investing in Africa is so interesting from a Middle East perspective right now.
It's very interesting because of some of the macro trends in Africa. So there's no other region in the world with the sort of population growth in Africa. By 2050, a quarter of the world will be Africans.
That's an amazing statistic.
It is. And when you combine that with the growth in GDP, for the first time in 2027, Africa will be the fastest growing continent, surpassing Asia. Fastest urbanization in the world, 500 million people moving to African cities. Urban people consume more. So the real big story in Africa is combined population growth, GDP growth, urbanization, and you have the African consumer, which is growing. And in any products that are to the African consumer, there is a supply-demand gap, and that is where we invest. A lot of private capital invests, and that's the interest in Africa. Now, when you talk about the Middle East, Africa and the Middle East are neighbors, and that's where it starts. Years ago, we saw the Middle Eastern sovereigns, institutions investing in food security. That has blossomed in the last 5 years to investing in all sorts of different industries. So you mentioned the Kenya Pact, but actually UAE is the largest investor in Africa now after the investment in Egypt, which stabilized the macro in Egypt.
Well, where you mentioned about the population growth, I presume that the demographic skews young. How do you really make the most out of that financially? What sectors, which countries do you target?
Right. So the average age in Africa is 19 years. And with the youth and the demographics, you have sophistication in anything tech. So we focus on the African consumer, pharmaceuticals, agribusiness, anything in education, etc. However, we add the element of digitalization. So in Africa, with the sophisticated young people, majority of Africans now have smartphones. Internet penetration has increased fivefold in the last few years. With that, there's an opportunity to put digitalization into companies so you actually have growth in revenues, growth in EBITDA. And then when we exit, as we're private equity fund managers, essentially we can get a hike in the multiples. So that together is a big opportunity.
Runa, hi, this is Jennifer in Johannesburg. Great to get you on again. I did want to ask, though, about your outlook for 2025, because in 24, we did see deal activity slow. We saw funding slow for a number of companies here. So what does that mean, then, for the outlook for the rest of this year?
Absolutely, Jen. Good to see you. So what we're seeing this year is a slowing down in some of the macro problems. So inflation has come down from last year and 2023 in almost every part of Africa, Morocco, East Africa, South Africa, after the successful elections there. And we're really keeping our eye only on two economies, the large economies, Nigeria and Egypt, where inflation is still high. But good fiscal and macro policies in Nigeria and the significant investment from this region, the UAE, into Egypt has also moderated that. So we'll keep our eye on those two large economies. We do see macro improving. We also see the consumer story I just talked about really accelerating. So really the sectors we're focused on is pharmaceuticals, financial institutions, anything in fintech. Those are some of the biggest areas we're looking at. So those are the trends generally that we're looking at in Africa.
Runa, I wonder how you see geopolitical activity affecting what we see within the PE and VC space in Africa, because that will inevitably affect investment.
Yes, you're right. So Africa is getting increased attention. So several new countries joined the BRICS coalition. South Africa is the president of the BRICS right now. The African Union was invited to join the G20, and actually that's where the presidency of South Africa comes in. That sort of attention means that there is geopolitical attention on Africa. That increases companies from those countries coming into Africa. Often we find industrials from those countries buying our companies. If you look at the Middle East, for instance, where obviously we are today, you're seeing increased activity into Africa, and some of it comes from the attention on Egypt, geopolitically and also as a big economic driver in Africa. So we're seeing our companies in Africa buying in Saudi Arabia, in the UAE, joint ventures, buying in Turkey. We're seeing increasingly sovereigns from this region buying our companies as we're exiting. So lots of links between the two regions, and we're seeing it really in a significant portion in our portfolio.
And Runa, just talking about your portfolio, MoneyPoint was the latest unicorn here on the African continent. Do you expect more unicorns then to come from this year, or should we just then expect more M&A activity, as you were just alluding to?
I think you're going to see both. So you are going to see increased tech activity, which, of course, is the basis of unicorns. So great entrepreneurship in Africa, increasing amounts of money, I expect this year going into the tech sector, the digitalization sector. Last year, there was a slowdown in that, and that increases the chances of unicorns. At the same time, M&A activity is not going to slow, and even within the tech sector. So we see PE companies buying venture capital companies. We see large unicorns looking at bricks and mortar. That will continue. We also see between the Middle East and Africa increasing familiarity and also increasing M&A activity.
Runa Alam, great to get you on the show. She is the DPI co-founding partner and CEO. Always great to speak with you, Runa. Thanks so much. Now, coming up, MTN Nigeria says MTN Nigeria shares surge after the government allows telcos to lift tariffs for the first time in 12 years. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, MTN Nigeria shares have surged as much as 10% after the Nigerian government raised telecom's tariffs by 50%. The adjustment, the first in 12 years, is half of what companies had asked for as they seek to weather harsh economic conditions. For more, let's bring in Bloomberg's Ndiro Oganga, who's following the story for us from Kigali, Rwanda. So, Ndiro, what did it take for the telcos to actually get the Nigerian Communications Commission to hike these tariffs?
Hi, Jen. So the best way to sum it up is a tough economic environment. If you look at inflation, it has hit a 30-year high. If I take you back to November of 2024, it clocked 34.6%. And this affects the prices of basic goods and services, including labor. Then you have the currency that has had a really tumultuous run. Last year, it lost 41% of its value to the dollar. And this also increased the prices of goods and services. But also, what it did is it led to FX losses for both big and smaller telcos, Airtel and MTN included. And the Ministry of Information was speaking, saying this is really warranted because if you look at also sectors like energy, the prices of fuel have risen astronomically, and it only makes sense. However, previous efforts by telcos to increase their tariffs have been met by hesitation, particularly from regulators. And you had these telcos making a case for themselves, saying that the current pricing mechanism wasn't aligned with economic realities, and it was going to hinder sustainability in the industry, forget profitability, just day-to-day operations. And that's why we've seen this upward hike. The Nigerian Communication Commission is saying that this upward adjustment will go into supporting continued investment into the industry in terms of infrastructure and also innovation.
Sure. And Ndiro, the other factor of it is thinking about how it's going to affect the telcos themselves and then also the end users. Do you have any insight into potentially what the benefits and the risks are?
Jen, there are far-reaching benefits to the telcos and also the end users in the long run. First of all, you mentioned in the intro that because of the upward adjustment, we saw MTN shares rise by 10%, and it was trading at 256.30 naira. And despite the fact that this upward adjustment is half of what they were asking for, Avia Capital says that it's still 10 to 20% above what they had factored in for 2025 earnings for MTN. And so in the short run, in the first couple of months, we're likely to see a negative effect. But in the medium term, it's likely to support medium revenue growth of over 30%. Other benefits include the proceeds will give them enough money to expand their base stations. They'll be able to roll out 5G coverage across different parts of the country, particularly rural areas, and also increase capital expenditure. However, on the flip side, end users can expect higher prices, which could trigger inflation in the short run. But then if you think about increased capital expenditure investment, if you think about improved quality of service, then this could increase productivity, and we're likely to see that offset the impact of inflation in the medium term.
Yeah, definitely a space we'll watch closely. Bloomberg's Ndiro Oganga for us in Kigali. Thanks, Ndiro, as always, for your reporting. Now, here's a few other stories we are following. ArcelorMittal's plans to shut down a century-old steel mill in South Africa are holding President Cyril Ramaphosa's dream of an infrastructure boom to ransom. The plant and two others it wants to idle supply what builders need for the rollout of power transmission towers, rail lines, and new roads. Ramaphosa has said he wants to turn the country into a, quote, construction site. And Congo's army says M23 rebels have tightened their stranglehold over key trading routes to the city of Goma in Eastern Democratic Republic of Congo. The rebels have been expanding their territory with the help of soldiers from neighboring Rwanda. The fall of the town of Minova puts the militia within 40 kilometers of Goma along the Rwandan border. And Turkey has declared a national day of mourning after a fire at a hotel in a ski resort killed 76 people. At least 51 were injured in the blaze, which broke out around 3:30 a.m. on a restaurant floor of the Grand Kartal Hotel in the resort of Kartalkia. The fire quickly engulfed the rest of the 12-story building, taking around 10 hours to control. Now, let's take a quick check at what our markets are doing just ahead of the trading day right now. As you can see, a bit of green, a lot of green on the screen right now, at least for U.S. equity futures, pointing to the upside. Still, markets are digesting a lot of the commentary that we are getting from President Trump on those supposed tariffs. And there is, of course, the other factor of tech, of the AI investment, and also of what we're seeing with a lot of the earnings companies. So a lot to pay attention to for the rest of the trading day. But that is where we leave it for Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg with Lizzie Burden in Dubai. Stick with us for Daybreak Europe.